Good day. As we enter the second quarter of the year, sticky inflation, sluggish growth, and now elevated financial stability risks mark the global economy. Despite somewhat better growth outcomes in the first months of the year, we see no material easing of difficult global economic conditions. Russia's ongoing war in the Ukraine weighs heavily on European growth prospects, while financial conditions in the United States continue to tighten. The growth outlook for China has improved, but is likely to remain modest by historical standards. Many economies in the developing world face weaker economic growth and prolonged adverse financing conditions. With inflation and policy rates remaining higher for longer and new weaknesses emerging in financial institutions, we expect global financial markets to remain volatile. Taking these and other factors into account, the SARB's forecast for global growth in 2023 is revised higher to 2%. Growth in 2024 is revised slightly lower to 2.5%. The International Monetary Fund's January update forecasts global growth at 2.9% in 2023 and 3.1% in 2024. The forecast will be updated in April. The South African economy contracted by 1.3% in the fourth quarter of 2022, considerably worse than expected at the time of the January meeting. The contraction was broad-based, consistent with the extensive load shedding experience in the final 3 months of the year. For the whole of last year, GDP growth of 2% was achieved compared to the 2.5% previously expected. For 2023, the bank's forecast for GDP growth is lowered slightly to 0.2% from the 0.3% expected in January. As a result of extensive load shedding and logistical constraints, the supply performance of the economy remains severely impaired. As previously noted, these constraints deduct 2 percentage points from growth this year. Over the forecast period, we expect household spending and investment to grow modestly even as load shedding and uncertainty continue to weigh heavily on consumption and investment decisions. Private sector investment is expected to remain positive, largely part reflecting efforts to overcome constraints in energy and transport supply. The SARB's commodity price index, which in historical terms still remains above its long-run average, is forecast to continue to ease. As a result of these factors, the economy is forecast to expand by 1% in 2024 and 1.1% in 2025. Economic growth has been volatile for some time, and prospects for growth appear even more uncertain than normal. An improvement in logistics and a sustained reduction in load shedding or increased energy supply from alternative sources would significantly raise growth. Further upside risks to growth could emerge from a stronger recovery in China if commodity export prices rise. Downside risks, however, emanate from more modest global growth rates and the lower terms of trade and trade volumes that would follow. Overall, the risks to the medium-term domestic growth outlook are assessed to be balanced. Nonetheless, the domestic and global outlook appears to be highly sensitive to new shocks. Core inflation remains high in much of the world, and financial vulnerabilities have re-emerged to create new headwinds. Turning to inflation prospects, our current growth forecast leaves the output gap around zero, implying little positive or negative pressures on inflation from expected growth. South Africa's external financing needs, however, are expected to rise. With a sharply lower export commodity price index, stable oil prices, and somewhat weaker growth in export volumes, the current account balance is forecast to deteriorate to a deficit of 2.7% of GDP for the next 3 years. Weaker commodity prices and higher state-owned enterprise financing needs will put pressure on financing conditions for rand-denominated bonds. 10-year bond yields currently trade at about 11.2%, despite the expected moderation of inflation over the forecast period. The rand has generally weakened over the past year. Recent weeks have seen further sharp depreciation and then some reversal as sentiment shifted abruptly in the wake of policy decisions in some major advanced economies. The implied starting point for the rand forecast is 18 rands 6 cents to the US dollar, compared with 17 rands 32 cents at the time of the previous meeting. Currency markets are expected to remain volatile. While headline inflation eased in major economies in December, price pressures remain clearly evident in measures of core inflation, services, and wages. In the G3 economies, consumer prices rose by 7.5% in 2022. Our estimate for inflation in the G3 is higher at 4.2% in 2022 and 2.1% in 2024, and is unchanged at 2% in 2025. The rise in South Africa's headline inflation rate has been shaped primarily by fuel, electricity, and food price inflation. Fuel price inflation last year averaged 34.4% and is expected to be negative 0.6% in 2023. The electricity price forecast is unchanged at 12.9% in 2023, 14.5% in 2024, and 10.9% in 2025. Despite a fall in global food prices in dollar terms, local food price inflation is revised up, in part due to the lagged impact of the weaker exchange rate. Food price inflation is now expected to be 9.9% in 2023 and 4.5% in 2024. Our forecast for core inflation is largely unchanged at 5.1% in 2023, 4.8% in 2024, and 4.5% in 2025. Services price inflation in 2023 is forecast to be 4.9%, lower than previously expected. Core goods inflation, however, is forecast higher for this year at 5.9%. The forecast for average salary growth and unit labor costs is somewhat lower in 2023 and higher in 2024 and 2025. With food and core goods higher in the near term, headline inflation for 2023 is revised significantly higher to 6.6%. Despite this, food and fuel inflation are expected to ease, resulting in a headline forecast of 4.9% in 2024 and 4.5% in 2025. Risks to the inflation outlook, however, are assessed to the upside. Despite some easing of producer price and food inflation, global price levels remain elevated. Russia's war in the Ukraine and China's economic rebound are expected to keep the global oil market relatively tight. Electricity prices and other administered prices continue to present clear short and medium-term risks. Domestic food price inflation surprised higher again in February, and risks of drier weather conditions have increased. Load shedding may additionally have broader price effects on the cost of doing business and the cost of living. Given sticky petrol and higher food price inflation, considerable risk still attaches to the forecast for average salaries. Interest rate levels in major economies are higher than projected in January, averaging 3.8% in 2023, 3.4% in 2024, and unchanged at 2.4% in 2025. Tighter global financial conditions raise the risk profiles of economies needing foreign capital, leading generally to weaker currencies. South Africa's risk premium is sharply higher and will likely remain elevated over the forecast period. Given load shedding, upside inflation risks, and larger external financing needs, further currency weakness appears likely. Inflation expectations increased strongly over the past year. Average expectations of future inflation surveyed in the first quarter of this year increased further to 6.3% for 2023 and 5.8% for 2024. Expectations for inflation in 2023, based on market surveys, are 5.8%. Long-term inflation expectations derived from the 5-year break-even rates in the bond market sit at 5.27%. Headline inflation breached the upper end of the target range in the second quarter of 2022 and is forecast to remain above it until the third quarter of this year. Headline inflation is only expected to sustainably revert to the midpoint of the target range by the fourth quarter of 2024. The forecast takes into account the policy rate trajectory indicated by the bank's quarterly projection model. As usual, the repo rate projection from the quarterly projection model remains a broad policy guide, changing from meeting to meeting in response to new data and risks. Against this backdrop, the Monetary Policy Committee decided to increase the repurchase rate by 50 basis points to 7.75% per year, with effect from the 31st of March 2023. 3 members of the committee preferred the announced increase, whilst 2 members preferred a 25 basis points increase. The revised repurchase rate is now less accommodative and is more consistent with the current view of risks to inflation. The aim of policy is to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of attaining the inflation target sustainably over time. The aim of policy is to anchor inflation expectations more firmly around the midpoint of the target band and to increase confidence of attaining the inflation target sustainably over time. Guiding inflation back towards the midpoint of the target band can reduce the economic cost of high inflation and enable lower interest rates in the future. Achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains would enhance the effectiveness of monetary policy and its transmission to the broader economy. Economic and financial conditions are expected to remain volatile for the foreseeable future. In this uncertain environment, monetary policy decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on potential second-round effects and the risks of de-anchoring inflation expectations. The bank will continue to closely monitor funding markets for stress. This concludes the statement of the Monetary Policy Committee. And at this stage, I would like to invite questions from members of the press. And as usual, please identify yourself and the media house that you represent. And the good panel here will attend to your questions. I must also apologize for Dr. Chris Lovald, who is joining us virtually. He is attending a meeting of his peers, the chief economists of central banks in Europe, but he is here with us virtually and will gladly participate in the Q&A session. The floor is open. Ziana, there is a question immediately here.
Kopano Gumbi from Reuters. Good afternoon, Governor, and to the Deputy Governors. 3 quick questions. So most recently, we've seen banks in the US and Europe have some instability. Did this come up in your discussions this week as something that would pose a risk to the South African inflation outlook going forward? And if so, in what ways? Second question, it looks like government and labor unions will most likely settle on a higher than anticipated increase for this year, wage increase for this year. Does this introduce the possibility of another rate hike later this year or put any additional pressure on inflation? Okay, then the last question is really about inflation expectations. We saw the research from the Bureau of Economic Research coming out just that the first quarter's inflation expectations are still quite high. Do you think that this rate hike is going to do enough to re-anchor inflation expectations around a point that the committee is comfortable with? Thank you.
Thanks, Kopano. Any others?
Good afternoon, Governor and Deputy Governors. It's Pranesha from Bloomberg. This afternoon's decision, or the outcome of this MPC meeting, was out of kilter with the expectations of most economists and the forward rate agreements. Can you just explain in a bit more detail how this decision was made and the extent to which the significant revision of your inflation forecasts influenced the decision to go with 50%. Sorry, not 50%, 50 basis points. I'd scared myself. Also, after today's move, just how far away from the end of the interest rate hiking cycle are we? Governor, you've said in the past that high inflation is a tax on the poor. But isn't there a risk that today's move or today's hike is going to increase the pain on those most vulnerable people that are bearing the brunt of the supply side inflation in this economy? And also, if I can follow on from that, given that interest rates are a bit of a blunt instrument to control inflation, can you tell us more about how the MPC understands the impact of higher interest rates and higher inflation on people's day-to-day lives, please? Thank you.
Since everyone is, it's Hilary Jaffe from Business Day. Since everyone is asking 3 questions, I feel obliged to do the same.
You can ask 4, it's okay.
I can ask 4. Thank you. There's a sort of, at the very end of the statement, there's sort of a sting in the tail. The bank will continue to closely monitor funding markets for stress. Could you explain exactly what you mean by that? Are you concerned about domestic funding markets? Are you concerned about the spillover effect from global funding markets? Could you just sort of spell that out a little bit more? And secondly, so you've now got a repo rate of 7.75 and a forecast inflation rate of 6%. That is strongly positive. Real interest rates. I mean, isn't, is there the risk of sort of overkill, if you like, in combating inflation? And thirdly, you've done a modeling exercise on inflation and GDP growth. Have you had a look at exactly how load shedding impacts on inflation and how much of an effect it might have? Thanks.
Thank you very much. Let me take a step, and then I will then try and distribute the things. Kopano, I think your question is also almost like related to what Hilary asked on the monitoring of funding markets. The bank instability in the US and the impact that it would have had on inflation. We can't pick what the impact of that banking stress is on inflation, but it does impact on the financing conditions because bankers in the US are now more cautious, and the regional banks are facing some stress and a loss of deposits and a drop in their share prices. And that means that there are financial stability issues emanating from the failure of that bank and another bank in the East Coast. And so it is more about the funding conditions than it is about the inflation. However, it does bring another dynamic. And the dynamic that it brings is that it creates a tension between central banks' financial stability mandates and the price stability mandates. And if you have seen the reaction of the markets in the US, it was that, because there are now fragilities in these regional banks, the Fed might not tighten policy. But they did, right? But it is that difficult now balancing act where there is a concern that the further tightening in the US could make the problem in these regional banks worse. It's not a nice space to be as a central banker where you are faced with that kind of a tension, but it has got also implications for financing conditions. So financing conditions had tightened. So now how does that get into the case of South Africa? The financing conditions are tightening in the US and elsewhere. That means that those countries that are relying on external financing and would require external financing could be facing funding challenges. Yet it is not that clear, because what it had also done is that it led the market to run ahead and think that the Fed might slow down or even stop the tightening of policy. And if that happens, there is a repricing of risk globally and a repricing of financial assets, including the financial assets in South Africa. So that is why we talk about the financial environment being very uncertain, because there are so many of these moving parts. Public sector wage settlements and whether it would lead to further rate hikes, it is just but one factor that could add to inflation. It is not by far the most important one. It is a significant one, but it is not the most important one. And in the end, it also depends on whether government is able to absorb that increase within the announced fiscal framework. We do not know, as you said, a settlement about to happen, so we do not know what will eventually be settled, and it will be difficult for us to make a case. Your third question becomes probably the most important and goes to the heart of monetary policy formulation, which is, given the inflation expectations, are the actions of the central bank adequate to get the inflation expectations to decline and be anchored at the target rate that the central bank is aiming for, which puts pre-inertia in all sorts of troubles. Because you see, pre-inertia says that understanding that high inflation is a tax on the poor, but what about the impact of the hike on the vulnerable? Well, the vulnerable must eat too, and the vulnerable must spend money on goods and services too. And the problem is, inflation is eating their income. And if no one does anything about inflation eating their income, they are going to be in an even worse position. And that institution in society tasked with protecting those incomes against the ravages of inflation is the central bank. And through deploying our policy tools, blunt as they might be, we hope that our actions will rein in inflation expectations and contain any further pressures in inflation, and get inflation expectations to be anchored at the midpoint of our inflation target range, because it is when inflation is anchored at the lower inflation rates that we are able to experience lower interest rates. For as long as you have got inflation elevated, you will not be able to have lower interest rates, which then links back to the question that Hillary was raising about the repo rate being at 7.75 versus inflation of 6% by the end of the year. And she says that that is pretty tight. No, Hillary, it is not. It is only 1.75% in real terms. And remember, what we deem to be the neutral real interest rate is estimated at 2.5% real. So even after this hike, you would say that what has actually happened is not that financing conditions tightened significantly, But what has happened is that monetary accommodation has been reduced further. That is what you are actually faced with here. And so, Prinesha, you then said that economists were expecting 25 basis points, and so were the FRAS and so forth. And sometimes I look at this and I ask myself, how could the same economists say we do not believe the Reserve Bank's inflation forecast? We think inflation is going to be higher, and at the same time expect that interest rates will rise slower. It's a contradiction in logic, right? So what they might be telling us is that they actually believe that the central bank is not serious about tackling inflation. But we know we are serious about tackling inflation. And we have been taking steps from November 2021 to tackle inflation. And today we have taken a further step in tackling inflation. And I am sure very soon they will think like us. You then raise a further question about how far we are from the top. If we only knew the top, we would be able to tell you how far we are from the top. The problem is, there are so many moving parts. Foreign interest rates, foreign inflation imported into our own idiosyncrasies with our own inflation, volatility in financial markets, financial instability in the regional banks in the US. There are so many moving parts at the same time that we are having to make policy on best judgment given the information that we have, and then add to all of those idiosyncrasies that we normally deal with of either it is wages, it is the rising electricity prices, rising fuel, rising food prices, the output gap closing, and so forth. Add to that something we hadn't thought about for a long time. We only saw load shedding as impacting on growth. And Hillary is asking the question, have you estimated the impact of load shedding on inflation, given that you are indicating that load shedding would raise the cost of doing business and the cost of living? We are busy with that exercise. It's not an easy exercise. I'm sure my colleagues will forgive me if I share this with you and say we estimate that load shedding could have easily added 0.5% to overall inflation. It's very early time. There are so many moving parts even there. You have got to understand the intensity of the load shedding. What is the stage of the load shedding? How many days would this thing? And it is a nightmare trying to forecast what that would be in the future. So I give you that 0.5% that we are expecting to have added to inflation. It's a guesstimate. Treat it as such. And of course, we are the central bank. I employ a lot of very clever people. I would rather call it an informed guesstimate. And I think we've covered everything except the question of Hillary about monitoring stress in the funding markets. We are a country with external financing needs. And so we have got to monitor whether we would still be able to attract foreign finance. And monitoring whether we are able to attract foreign finance means understanding the state and the condition under which global financial markets and financing conditions are at, so that we could see whether we would still be able to finance. If we are unable to finance, we know what normally happens. What normally happens is that the price at which you finance adjusts. And in our case, either it is the bond yields that go up, and or the currency weakens. And that is why we highlighted the impact of this on the currency. But this statement is also not a new statement about monitoring stresses in funding markets. When in 2020 and 2021 we experienced stresses in the domestic funding markets, and when there was almost a drying up of liquidity and people were no longer showing prices, the Reserve Bank stepped in and provided liquidity so that the funding markets could continue to function. And we did that not because we just wanted to be nice to government or to anybody else. It is because our own monetary policy operations framework operates on the basis of collateral. And if you do not have a functioning financial market, it is difficult to price that collateral. And it is for that reason that we monitor those funding markets, and if we think there is stress, we step in. I think I've covered everything, but I might have forgotten something. No? Prinesha.
Thank you. Governor, I think since the onset of the pandemic, most credible global central banks have been moving in the same direction. Given that you've just mentioned South Africa's idiosyncrasies, do you see a scenario where the South African Reserve Bank would continue hiking while some of your peers hit pause?
That is your question.
That's my question.
Thank you. Are there any people on the line?
Yes, Governor. We had a question from Atul Ramini that related to the U.S. banking crisis and inflation, but he added two more questions where he's asking, how would you describe our banking supervision locally in the wake? How would you describe our banking supervision locally in the wake of the banking crisis? Is there any change in your approach? And are you seeing any signs of a credit crunch in South Africa? Those are all the questions, Governor. Thanks.
Credit crunch in South Africa. DG Naidu, you can crunch the credit, and the CEO of the Prudential Authority knows more about supervision than us. Rashad, there is no free lunch. You will do whether the SARB will be moving with the others or will pause or do the opposite. So, who wants to start? Fundi?
Okay, thank you. So regarding the approach to banking supervision locally, South Africa ascribes to international standards around the supervision of banks. So we apply the Basel principles to bank supervision. You would have seen in some of the media releases related to the US banking crisis that there's a lot of reference to what it is that the regulators look at and what did they not do relative to the bank that got into trouble. So we have assessed where our banks sit in South Africa. We have looked at the risks. We do follow a risk-based approach to our supervision in terms of what it is that we assess. We do monitor credit risks that banks face. We do assess the exposures and the interest rate risks in the banking book across our banks in South Africa. So at this point in time, we think that our supervision is sufficient enough to pick up the risks. And we're also guided by institution-based issues. So if there are problems in particular institutions, we go in and we tackle those. So I hope that that's sufficient. If there's a requirement for a follow-up, I'm happy to do that. Perhaps over to you, Kuben.
Thank you, Chair. Thank you, Fundi. At this stage, we're not seeing any signs of a credit crunch. If you define a credit crunch as a sharp contraction in the supply of credit by the financial sector, In fact, credit extension over the last 12 to 15 months has probably been better than the preceding period. We've had a long period, sort of 7 or 8 years of fairly low credit extension in South Africa. Of course, credit extension fell sharply during the COVID period and has picked up since then. And even if we look at data for the last 3 or 4 months, notwithstanding a fairly weak economy, credit extension is actually okay. It's not too hot, not too cold. It's rising somewhere between sort of -1 and +1 in real terms, depending on which category of loans you're looking at. In fact, credit extension to the corporate sector has been slightly higher than it's been to the household sector in the last year or two. And in some ways, that's a positive. It reflects slightly better investment conditions, largely related to renewables, largely related to firms trying to invest to try and minimize the impact of load shedding. So no, at this stage, we don't see signs of a credit crunch. Ironically, higher interest rates also makes banks, particularly large banks, more profitable, and often that feeds into the willingness to lend. More profitable banks are more likely to support an economy than less profitable banks. Thanks.
Thank you very much. So I guess this requires a bit of a multifaceted answer. At one level, obviously, when we think about the monetary policy reaction function, we're asking what are the main drivers of inflation, and where are those drivers coming from? Are they coming domestically? Are they coming from import prices? So if globally central banks decide to stop tightening because their own inflation is moderating, and import prices that we often depend on is moderating, that will contribute to us moderating monetary policy. But if import prices are moderating, but our own domestic pressures continue in an upward direction, we will not necessarily slow down. So I think that's the one side of it. The other side of it is, I think that what has happened is that we're all acutely aware of global spillovers. That at the end of the day, when a country like the Fed tightens, it has spillovers on the South African economy. We have to factor in those risks, but what do those risks for us ultimately mean for inflation? So what it means is that if the global spillover means that there's either an exchange rate depreciation or an exchange rate appreciation, either way will impact on our policy. So I think it's not a straightforward thing. It's at the end of the day, what drives inflation and how much of that is coming from a global transmission mechanism and how much of it's coming from domestically. It is the case that it makes it a bit easier when countries like the Fed are slowing down their own kind of monetary policy tightening. That does help the South African monetary policy reaction function. Thanks.
Thank you very much. I'm told there are no more questions online. Hillary, is there any other? So Hillary will close the show.
Could I ask about growth? You've now cut your this year forecast to 0.2, though you've upped the forecast for the next couple of years. You and the IMF seem to be at the kind of pessimists' end of the scale. I know we're arguing decimal points here, but a lot of economists have higher forecasts for the current year, in part, as I understand it, because they think the economy is more resilient to load shedding. That very investment in renewable energy and backup power that you mentioned may have positioned the economy to ride out load shedding better. I mean, how do you account for why you are a lot more pessimistic, if you like, on growth in the market, at least for the current year? And just really final question. I don't know if every meeting, I don't know if some meetings are more domestic concerns about inflation and more external concerns about inflation. But if you had to weigh up what were the kind of top of the list of your concerns this time about, would the external or the imported sort of drivers have been more of a concern at this meeting than usual?
Okay,
Thanks.
Rashad, I'm going to give you the last one. Chris, You can't be connected online for nothing. You've got to answer the question about growth.
Sure. I hope you can hear me. Look, I think there are a couple of different things going on there. I mean, one is just simply that, you'd have to talk to them, but I'm not always sure that the private sector analysts have adjusted their growth rates quite as regularly as we do. Obviously, we have to do it every other month, and so we have to rethink our whole GDP forecast, essentially on a monthly basis. So I suspect that there's a bit of catch-up going on with some of the private sector economists coming closer to where we are or have been, rather than going in a different direction. Certainly, the IMF was more bullish until recently and have now revised down. The two primary drivers of our view for this year come from load shedding, of course, and the way in which we think that impacts on supply in the economy, and then also filters through into demand. So things like gross fixed capital formation and household consumption expenditure are marked down a little bit because we feel that load shedding is going to pass through into demand. We haven't changed that much between January and now, sort of 0.1, as you said, on the margins for some of the categories. One of the areas that we're a little bit more concerned about is what's going to happen to net exports contribution to growth. And part of the reason for that is just simply that the Q4 outcomes were very negative. So that had two effects. It gave us some indication of particular components of growth that are surprising to the downside, like exports. And it also lowered the starting point for our annual forecast a little bit. Now, we've actually discounted that. We could have been a little bit more bearish for this year, given the size of the detraction from growth from Q4, but we didn't pencil all of that into our number. So, there are different kinds of things going in there. On the issue of energy investment, we've said this before. For some time, we've been caught out, surprised to the upside by the strength of private investment. We think that quite a lot of that is going into their efforts to solve their own load shedding problems, so embedded generation and that kind of thing. And as we said at the time of the last meeting, we would like to pencil in stronger investment numbers on the back of very concrete plans to expand embedded generation. But we're waiting to see what those numbers actually look like. And so that will be a moving target. It may have significant effects on investment going forward. But we haven't added those in at this stage. In fact, our estimate for private investment this year is a little bit weaker than we had it at the time of the January meeting. Thanks.
Yeah, Hillary's question, another tricky one. So obviously we're going to a meeting and we discuss conjuncture. And it turns out that if in that meeting, a global event overshadows what's happening domestically, we have a serious discussion on that. Whether that one can quantify whether that global event disproportionately played more of an important role in the monetary policy decision is a more difficult issue. It turns out that obviously we went into this meeting where the global banking crisis was a big issue. We discussed it. It took more time in our conversations, global factors, than it otherwise would have had we not had the SVB, the Credit Suisse issue. So I think that, and naturally what happens is that if we go from one meeting to another and there have been domestic factors, like we think that load shedding has contributed to high inflation, it is that domestic factor that occupies a lot of our conversations. I think there would be a hypothetical case where if we felt that this economy was inflation was moderating, but that there were massive shocks abroad, that every other country was tightening, given the last question that I answered. In those circumstances, one can guess that the external would contribute a lot to our thinking in our final monetary policy stance. But I guess that's the best I can do at this stage.
Thank you very much for your attendance. That concludes the proceedings for today. We will see you in May.